and welcome back to the Segal Sea Trade Podcast. I'm Research Analyst Trisha Mohite, and I'll be your host for today's episode. Today, we are diving deep into the fascinating world of tankers, and to be honest, it's been an interesting week so far. And for that, we have Mr. Sandesh Ghandat who is joining us today. He's an industry expert with years of experience navigating the highs and lows of the shipping market. So it's great to have you here, Sandesh. Welcome to the episode.
Well, thank you, Trisha. It's great to be here. There is so much happening in the tanker market right now. It's an exciting time to discuss it.
You're absolutely right, Sandesh. So let's start with the crude oil tankers, especially those VLCCs and Suezmaxes that are the backbone of the global oil transport. So, Sandesh, we've seen some interesting dynamics in the VLCC segment recently. And, the rates have been surging midweek after Saudi Arabia's April loading nominations. So, what's driving this market strength and how do you see it evolving?
Well, great question, Trisha. The VLCC market is kind of playing out like a well-scripted drama. I have to say that because each act is revealing new twist, and let me break it down. First, that late March rush of cargo inquiries gave owners a kind of a shot of confidence, but it wasn't just optimism. Actual fundamentals, you know what, they were tightening. As Saudi nominations came in, more cargoes emerged, but vessel supply didn't keep up. Add to that a weakening US Gulf to China trade, which pushed some ships back into the MEG, and they were delaying tonnage from getting absorbed elsewhere. But having said that, just look at this. Numbers don't lie. TD2 and TD3C, they surged by 13.18% and 10.38% week on week, and they reach around world scale 68.06 and world scale 64.85 respectively. Now, ex-WAF, that is West Africa market, rates climbed past world scale 60, and it helped by Suezmax tightness and rising ton miles from the US Gulf and Brazil. And let's not forget ex-US Gulf rates. They jumped from 7.6 million to 7.8 million for China-bound cargoes. Not that much, but it was a marginal growth. And that not just firming, it's a clear sign that the demand remains robust despite some minor end-of-week pullbacks. Now looking ahead, it's a battle of supply and demand as we all know. If new inquiries picks up, we could see VLCC rates pushing even higher. So either way, we are in for an exciting few weeks ahead.
That's definitely fascinating, Sandesh. And what about the Suezmaxes? I heard Indian bound cargoes played a big role last week. So, what do you have to say about that?
Well, absolutely. The Suezmax market had its own story to tell. Indian PSUs, they quoted six cargoes last week. It was quite amazing with one cargo even covered at world scale 130 for MEG, that is Middle East Gulf and East Coast India routes. But here is where it gets interesting. Rising VLCC rates actually spilled over into the Suezmax segment. During the midweek last week, we saw stability, and it was special thanks to ample vessel availability for the April loadings and specifically early April loadings. However, as we're reaching to the end of the week, tonnage kind of get tightened, and the tightening tonnage list drove rates higher for India bound voyages. And that said, some charterers are exploring alternatives due to mixed market sentiment. Now, what is the key takeaway? The key takeaway is in simple line: the Suezmax market is walking a tightrope. It could stabilize or even decline slightly unless new demand emerges.
That's quite interesting, Sandesh. The VLCC market is surging, the Suezmax market is walking on a tightrope. Now, let's see what is the situation for the Aframaxes. This segment saw some interesting dynamics, I see, especially in the MEG and the Southeast Asia region. So, could you tell us more about Aframax segment?
Well, Aframax rates held steady for most of the last week, and it kind of fluctuating within the narrow range due to limited activity. However, tight tonnage, especially for well-approved units, with pre-March 30th laycans, they kind of help maintain a firm market tone. So by the midweek, some vessel opened in the West Coast India region, which eased the pressure slightly, but as the week ended, rates started climbing again. It was mostly driven by constrained vessel supply and private fixtures happening in the background. Now, over the SEA, that is, Southeast Asia market, the market began on the strong note with the demand for late March cargoes. They kind of largely covered. While activity slowed, a tight tonnage list through early April allowed owners to maintain a leverage. So charterers, they try to hold back inquiries to counter bullish sentiment, but with vessel availability, specifically in the Australia, well, it remains limited and rates stayed on an upward path. So to put things in a perspective, TD8, it kind of slipped slightly by 2.19%. It's a marginal decline to world scale 146.43. While TD14, it surged by 6.47% to world scale 136.18. Now, Indian PSUs, they kind of did not contribute anything because they did not caught any cargo last week, which added a kind of a layer of uncertainty.
Thank you so much, Sandesh, for giving us an overview of such dynamic market that the crude market has been going. Now, let's shift gears and talk about the product tankers, especially the MR and the LR segments. Now, Sandesh, I see the MR market has been on fire lately with freight rates. They have been skyrocketing across key routes like TC 1235K from Sikka to Japan. So, could you tell us what's actually fueling this bullish momentum?
Oh, the product tanker market is kind of electric right now. We are witnessing rate surges that are hard to ignore. And it's all driven by a complex mix of, demand, supply, and shift in the global trade patterns. Now let's start with the LR1s. We have a benchmark TC5 route that is AG Japan. Here rates surged to world scale 180.94. While LR2s on TC1, they spiked even higher to world scale 163.61. Now several key factors are at play here. So first, Middle Eastern refineries are running at a full capacity, leading to a surge in product exports. Second, a tonnage list that has tightened significantly due to vessels repositioning elsewhere, reducing available supply. Then the third and final, global refined product flows. They are being rebalanced due to changing demand patterns, particularly in Asia. Now look at India. February's petroleum production data tells an interesting story. Now refiners, they kind of churned out 22.5 million metric tons of products, with diesel leading at 42.5% share. But here is the kicker. India's petroleum export rose by 5.8% year on year, with gasoline and fuel oil finding strong buyers across Asia. Meanwhile, imports of petroleum products declined by significant 17.5%, and it kind of a signaling a shift towards a greater self-sufficiency in the refined fuel output. Now, let me turn it back to the tanker market. We have to see MR tanker market. The TCC benchmark route, that is AG to East Africa, it has been the absolute star, soaring to world scale 265. This represents a staggering 22.33% jump in earnings. It is a clear indication of robust demand for shorter haul product movements. So even in the Atlantic, MR tankers are holding their ground. So freight rates on the UKC, USAC surged by 20%, while USG Caribs rates nearly doubled. But main question is that what's driving this? It is a combination of tight supply and strong demand for middle distillates and gasoline, especially as the seasonal consumption picks up in a key market. So additionally, disruption in the traditional trade flows caused by sanctions and refinery maintenance and shifting demand centers, they have kind of created arbitrage opportunities that, product tankers are capitalizing on. But then the big question remains, are we in a bubble? So the short answer is not necessarily. While these rates are high, they are not purely speculative. Structural factors like refinery expansion in the Middle East and Asia, in the Red Sea crisis, and the affecting routing, sustained gasoline and diesel demand. The overall, it kind of suggests that we are looking at more prolonged period of strength. So of course, supply side adjustments like new vessel deliveries or a slowdown in a demand, it could temper this rally in the medium term. But as of now, all signs point to one single thing, that is sustained bullish phase through at least Q2 and potentially beyond.
Thank you so much, Sandesh. I guess the petroleum market is definitely telling us an interesting story, by holding a strong ground and especially the surging in the Asia region. Now, finally, let's talk about a quieter segment, but one with immense potential, and that is the LPG tankers. So, what's happening in this space? Could you tell us more about?
Well, LPG tankers may not grab headlines like crude or product tankers, but they are quietly making the waves. Last week, in the East of Suez market, only three deals were concluded for early April laycans. But here's the kicker. You know what? Freight rates, they rose sharply. For instance, Ras Tanura Chiba fixture, it hit $70 per metric ton after an Indian utility booked a late Friday fixture for early April AG timing. Meanwhile, in the west of Suez market, Houston Chiba freight climbed to $110 per metric ton via Panama due to tight tonnage availability. So what does this mean? LPG market are benefiting from tighter supply demand fundamentals globally. So if inquiry picks up after Saudi Arabia releases its April acceptances, as many expect, we could see even stronger rate momentum.
Wow, Sandesh, you've given us so much to think about today, from surging VLCC rates to bullish product tankers and promising LPG trends. It feels like every segment has its own unique story.
That's right, Trisha. The tanker market is dynamic. It reflects global economic shifts and it's in the real time. So whether it's geopolitics or trade flows changing overnight, there is never a dull moment.
And I guess with that, we would wrap up today's episode. Thank you so much, Sandesh, for being a part of this episode and sharing all of your views and opinions on the tanker market.
Well, thank you, Trisha, for inviting me once again. It's a pleasure to be here and sharing my thoughts and knowledge with you. Thank you.
And to all our listeners, thank you so much for tuning in. Do not forget to share and subscribe to our podcast. Until next time, navigate safely and stay informed.